Hello students, this is Dr. Mamta Sharma, Assistant Professor, Department of Commerce, Kishanlal Public College, Rewari. This is our third lecture on residence and tax liability. In our previous two lectures, we have discussed the rules regarding determining the residential status of individual and various other persons. So in today's lecture, after understanding the whole concept about the residential status, like how we determine the residential status in case of individual, HUF, firm, AOP, BOI, company and other persons. What will be the incidence of tax? Like what is the scope of total income and how these incomes will be taxable for different type of residents. As in our previous two lectures, we made it very clear that there are three type of residents, like ordinarily resident, not ordinarily resident and non-resident. So in this lecture, we will start with the scope of total income on the basis of these different residences, or simply known as incidence of tax. Incidence of tax on a taxpayer depends on his residential status and also on place and time of accrual or receipt of such income. So, without wasting much more time, let us start our today's topic. These were the different slides which we have already discussed in our previous lecture. Now, incidence of tax, scope of total incomes. Here in this slide, income is divided into two parts: Indian income, foreign income. It means how the income will be assessed. First, it will depend upon the nature of income. Either it is an Indian income or foreign income. So, Indian income simply means there are 4 points which we have written under the head Indian income. Income earned in India, income deemed to be earned in India, income received in India, income deemed to be received in India. First, income earned in India. It means any income whose source of generation is within India will be known as Indian income. Like simply you can take the example, income from house property. If the house property is located within India, simply the source of income is in India. It will be known as income earned in India. Earned simply means the income where it is being generated. What is the source of income or the source of income where it is located? If it is located within India, it will be simply taken as income earned in India. Income deemed to be earned in India simply means where, what is the first place of earned. It means where it is first earned for the first time, not the place of its earned on subsequent basis. Where it is assumed that it is to be earned in India. Then income received in India. The term received simply means receipt of income on the first occasion. The place of its receipt shall be the place where it is received for the first time, and note the place of its receipt on subsequent remittance. Like the first income received in India, then brought to foreign country. Then the first place of its receipt is in India. Then it is brought to abroad. So remittance does not matter. The place of receipt on first occasion matters. Clear? Then income deemed to be received in India. Deemed to be received in India simply means that the income has not been actually received, but it is deemed to be received. Like you can take an example, the annual accretion to the account of any employee participating in a recognized provident fund is not actually received by the employee, but it is deemed to be received during the previous year by him under the law. Clear? Like you can take another example where the individual has been employed by the central government in India, but he received this income outside India. He has been employed by the central government of India, but has received the income outside India. Then here the income will be taken as deemed to be received in India. Reason being its source belongs to India, as he is an employee of Indian central government. So the place of its receipt doesn't matter, as it actually belongs to the Indian source. Clear? So in this way we can first categorize the income which is taken as an Indian income. And whenever we find that the income is in the nature of Indian income, then will be taxable for all type of residents, like for ordinarily resident, not ordinarily resident, non-resident. Clear? It simply means that if the assessee has been non-resident in India, definitely he has to pay tax on all incomes which are Indian incomes. How you will find out the Indian incomes? Here we have categorized the different situation. If it is earned in India, it is received in India, deemed to be earned in India, and deemed to be received in India. It means any income which belongs to India then will be taken as Indian income, and then will be taxable for all type of assessees. Clear? Now go for the second, foreign income. Foreign income is here divided into two parts: business income, income from other source. Business income again categorized into two parts, or we can understand with the help of this diagram, like business income where the business is controlled from India, or the second case where the business controlled from outside India. First, here one point is very clear, that the foreign income is not taxable for non-resident. Clear? It means one point is very clear: in case of incidence of tax, non-resident will pay tax only on Indian incomes under the Indian tax law. It means he is not taxable for any foreign incomes. definitely tax will be paid, but only in the particular foreign country where he has earned the income. Clear? Let us have again a look on foreign income. Foreign income is divided into two parts: business income, income from other source. Business income, first business controlled from India, and then second case business controlled from outside India. If the business is controlled from India, then ordinarily resident, not ordinarily resident, both will be taxable. If the business controlled from outside India, then definitely only ordinarily resident will be taxable. You can understand this concept with a simple point that ordinarily resident means the person who has been resident in India. It means he purely belongs to India. So he has to pay tax on all the incomes which he is receiving in India, as he belongs to India. He has been resident in India, so he has to pay tax on all type of incomes. So two points are very clear. Ordinarily resident will pay tax on all type of incomes, and non-resident will pay tax only on Indian incomes. And what about the not ordinarily resident? There are two things. Not ordinarily resident will pay tax only on the Indian incomes as well as on foreign incomes where the business is controlled from India. If the business is controlled outside India, then only ordinarily resident will pay tax. And income from other sources, like other than business income, if there are any income left which is in the nature of foreign income, then it means the source of income do not belong to India. In that case, tax will be paid by only the ordinarily resident. Clear? 3 points are very clear. First, ordinarily resident will pay tax on all type of incomes in India. Non-resident will pay tax only on Indian incomes in India. Not ordinarily resident will pay tax only on Indian incomes as well as the foreign income where the business is controlled from India. Clear? The incidence of tax is also summarized here, like the scope of total income. You can also understand with the help of this table, like for which person it is taxable or not. Here it is clearly mentioned in the table, as there are three types of person: resident, not ordinarily resident, non-resident. First, income received in India. As we have already discussed, income received in India, it means it is an Indian income, and Indian income will be taxable for all type of assesses. So simply yes, yes, yes. It means it is taxable for resident, not ordinarily resident, as well as non-resident. Income deemed to be received in India, income earned in India, income deemed to be earned in India. First 4 point clearly shows that these are Indian incomes. And what we have concluded, that the Indian incomes will be taxable for all type of assesses. This is why in this table, yes, yes, yes is written for all the three assesses up to 4th point, as the first 4 point, as in the first 4 points the income directly relates to the Indian income, or these incomes are Indian incomes. This is why resident, not ordinarily resident, and non-resident will pay tax on in the first 4 points. Income received and earned outside India. from a business controlled from India. Outside India, it means it is a foreign income. In the sixth point, you will also find income received and earned outside India from a business controlled from outside India. So in the fifth and sixth point, it is very clear that these are not the Indian incomes. These are the foreign incomes. So what we have decided in case of foreign income, ordinarily resident definitely will pay tax, and for the rest of two residents, first we will find that business controlled from India or not. Like non-resident will pay tax only on the Indian incomes. So after fourth point, rest of the incomes, if these are of the nature of foreign income, then will not be taxable for non-resident. For ordinarily resident, all will be taxable. Not ordinarily resident, depending upon the business control and management. So in the fifth point, it is very clear that the business controlled from India, it means it will be taxable for not ordinarily resident. In the sixth point, income received as well as earned outside India, and the business is also controlled outside India. It means this income will be taxable only for the ordinarily resident, not for the other two residents. Then in the seventh point, we have written income received and earned outside India from any other source. So any foreign income will not be taxable for not ordinarily resident and non-resident. It will only be taxable for the ordinarily resident. And what about the last 8th point? Income earned or received outside India in earlier years but later on remitted to India during the previous year. First, understand this whole concept. Income earned or received outside India. First, it means it is a foreign income. But after then, we have written in earlier years. It means it does not belong to the previous year, but later on remitted to India during the previous year. First, it is a foreign income, but second point states that it does not belong to the previous year. Remittance has been made during the previous year, so it will not be taxable for any of the assessee. Reason behind this, as this income does not belong to the previous year, this is why it will not be taxable for any of the assessee. There may be another concept behind this non-tax liability, as it belongs to any previous year, like it belongs to any earlier year. In that earlier year, we don't know what was the residential status of that particular person. He may be non-resident, ordinarily resident, not ordinarily resident. So it should be taxable for that particular year after determining the residential status of a person in that particular year. Clear? Simply you can conclude it with, if any income which is not received or which does not belong to the previous year will not be taxable for any of the residents. Clear? We can understand this whole concept with taking an example. The following are the incomes of Shri Rupak Mishra for the previous year 2019 to 20. There are different points which are given in this question, and at the last it is written compute his taxable income if he is resident, not ordinarily resident, non-resident. In this illustration, we have been given with the information that Shri Rupak Mishra is having some incomes, and we have to find out his taxable income if he is resident, not ordinarily resident, non-resident. In some other cases, you may see that first you have to find out the residential status, and then you have to compute the taxable income as per his computed residential status. Clear? This is a simple illustration just to make you aware about the taxable incomes. It means what will be the taxable incomes in different cases. So we will assume him as ordinarily resident, not ordinarily resident, as well as non-resident, and in all the three cases we will decide that which income is to be taxable or which income is not to be taxable. Clear? So let us start with the first income. First income which is given in this illustration is dividend from Indian company. So dividend from an Indian company, first it is Indian income. Clearly mentioned, dividend from Indian company. It means it is an Indian income. So by the rule, if we determine the taxable income, we will say that any Indian income will be taxable for all of the residents. Clear? But this dividend from Indian company will not be taxable for any of the residents as it is fully exempt. So one point you must always know, that the income which is not taxable or which is exempt will not be the part of taxable income. Exempted incomes will not be the part of taxable incomes. So dividend from Indian company is fully exempt. This is why it is not to be taken as a part of taxable income. Clear? Second point, profit from business in Japan received in India. Profit from business in Japan received in India. You can divide this income into two parts. Profit from business in Japan, it simply means it is a foreign income. Received in India means it is an Indian income. So how you will decide that either it is to be taxable or not? Profit from business in Japan received in India. Whenever you have been given such type of information, you will only consider its receipt, as we say that the income received on the first occasion matters. So for the first occasion or for the first time it is received in India. So this is why it is to be taken as Indian income. And what we have decided in case of Indian income? Indian income will be taxable for all type of assessees. It means it will be taxable for resident, not ordinarily resident, as well as non-resident. We can also find out this in the solution, that in the solution we have written income received in India, where we have written profit from business in Japan received in India, 1,20,000, 1,20,000, 1,20,000. You can also write down in this way that first income was, like, look in this illustration, First point was dividend from Indian company. You can also write this point into the solution, and you can simply write exempt, exempt, exempt. So it depends upon the nature of students, that how they take the, or how they write down the solution. So it doesn't matter. We can also write in this way, like incomes which are not to be taxable, you can also mention in the solution, or if you do not mention in the solution, you have to give it into the working notes in extra additional points, that why you have not taken the first point. You can simply mention that income like dividend from an Indian company is fully exempt. This is why it is not to be taxable. And then second, profit from business in Japan received in India. It is an Indian income, so will be taxable for all type of assessees. Now the third point is profit from business in Pakistan deposited in a bank there. The business is controlled from India. Profit from business in Pakistan deposited in a bank there. The business is controlled from India. First, profit from business in Pakistan. It means it is a foreign income. Deposited in a bank there, it means its receipt is also outside India. It means earned as well as received does not belong to India. Clear? It simply means it is a foreign income. What we have decided in case of foreign income? Foreign income is not to be taxable for non-residents. So first, one thing is very clear, that it is not to be taxable for non-residents. Then, as it is a business income, we have categorized foreign income into two parts, business income and other income. For business income, it was mentioned that if the business is controlled from India, then will be taxable for ordinarily as well as not ordinarily resident. You can also find this in the solution, where we have written profit from business in Pakistan but controlled from India. Amount is rupees 2 lakhs, and this 2 lakhs will be taxable if he is resident as well as not ordinary. It means the business, you can also understand this concept in this way, business in Pakistan and the income also received in Pakistan. If this control and management is not mentioned in the illustration, then it will only be taxable for ordinarily resident. But as it is clearly mentioned that the business is controlled from India, this is why we will take this in this way, that it is a foreign income but controlled from India. So will be taxable only for ordinarily resident and not ordinarily resident. Now for the next income, profit from business in Indore. Profit from business in Indore, controlled by London head office. So first, just guess, either it is an Indian income or foreign income. Definitely it is an Indian income, as profit from business in Indore, which is in India. So control and management here doesn't matter, as it is an Indian income, the income earned in India, and the Indian income is taxable for all type of residents. Amount is rupees 1,10,000, and we have written this 1,10,000 in case of all the three assessees. Then the next point is interest received from a non-resident, Mr. Rahim, on the loan provided to him for a business carried on in India. Interest received from a non-resident, Mr. Rahim, on the loan provided to him for a business carried on in India. As the interest is received from a non-resident, but this loan was for the business which is in India. So it is to be taxable for all the three residents. This is why amount 50,000 is written in case of all the three assessees. And the next point is income was earned in America and received there but brought in India. Income was earned in America. It means it is an Indian income earned in America and received there. It means the receipt on the first occasion is also outside India but brought in India. But brought, it means remittance is given. So as we have already discussed, remittance does not matter. Earned and received for the first time matters. So purely it is a foreign income. Income was earned in India and received there. It is a foreign income, and we have categorized foreign income in two parts: business income and other income. Here in this point, no business information is given, so we will simply assume it as other income. And other incomes are only taxable for the ordinarily resident if it is foreign income. Clear? Income was earned in America and received there. It means income earned outside India, received outside India, but later brought in India. So later does not matter. So this 80,000 will be taxable only for the ordinarily resident. In this solution, at the end you will find out that income earned in America and received there is written only in case of resident, as it is a foreign income and other foreign income will be taxable only for ordinarily resident. And the next point is share of income from Indian partnership firm. Share of income from Indian partnership firm is fully exempt in the hands of the individual, as the firm paid tax on the firm's income and it goes free of tax in the hands of the individuals or the partners. So it will be fully exempt. Yes, definitely it is an Indian partnership firm, but you have to keep in mind that share from HUF, share from AOP, BOI, share from Indian partnership firm is always exempt, fully exempt in the hands of the members. So Indian income here does not matter. The point of taxable event matters, like it is non-taxable income. So simply it will be exempt in all the three cases. Then income from house property in India received in America. Income from house property in India. It means first point states that it is an Indian income. Received in America states that it has been received outside India. So first, the source of income is in India. It means it is an Indian income. And the Indian income is taxable for all the three assessees. You can also find this in the solution. Income from house property in India but received in America, amount is 62,000 and we have written this amount for all the three assessees. Clear? Simply assessing this income as an Indian income, this is why it is taxable for all assessees. And the next point states that interest on debentures of an Indian company received in Dubai. Interest on debenture of Indian company, it means it is an Indian income. So Indian income will be taxable for all type of assessees. 25,000, you can also see this in solution. 25,000, 25,000, 25,000. Being an Indian income, it is to be taxable for all assessees. Capital gain in the 10th point, capital gain on sale of agriculture land situated at Ajmer. Capital gain which comes under the head capital gain on sale of agriculture land situated at Ajmer. Ajmer, which is within the boundaries of India. So it is an Indian income. And what you say? Indian income is to be taxable for all type of assessees. 48,000 here we have written for all the three residents. So this is the concept which you can understand with this illustration. You can take the help of other illustrations for determining the residential status as well as the taxable incomes. Like first, identify the residential status, like he is resident, not ordinarily resident or non-resident. Then scope of total income, like which incomes are to be taxable or not. I hope this lecture will help you in understanding the concept of scope of total income or incidence of tax. You can also conclude, simply we can conclude that the income for determining the taxable income simply divided into two parts: Indian income, foreign income. If the income is Indian income, then will be taxable for ordinarily, not ordinarily, as well as non-resident. If the income is foreign income, then again divided into two parts: foreign business income or other income. Foreign business income, if it is controlled, if the business is controlled from India, then will be taxable for ordinarily as well as not ordinarily resident. If the business is controlled outside India, then will only be taxable for ordinarily resident. And any other foreign income will be taxable only for the ordinarily resident. It means, which we are again repeating, or which we can again understand, is Indian income will be taxable for all residents. Foreign income is taxable only for ordinarily resident. Non-resident will pay only tax on Indian incomes. Clear? Not ordinarily resident will pay tax on all Indian incomes as well as foreign business income where the business is controlled from India. In this way, you can understand this whole concept, and I hope this will help you in determining the residential status as well as his taxable incomes. Thanks a lot, students, for listening me carefully. All the very best.